Have you ever wondered why the stock market crashes the moment the Federal Reserve raises interest rates? Or why a 0.25% change causes so much panic among investors? In today's video, we're diving deep into one of the most important, yet often misunderstood topics in investing: how interest rates affect the stock market. Whether you're just starting your investment journey or trying to better understand the news headlines, this video will give you the clarity you need to stay informed and make smarter decisions. Let's start with the basics. What exactly are interest rates? In simple terms, interest rates represent the cost of borrowing money. When you borrow money from a bank, you pay a percentage extra. That's the interest. In the United States, interest rates are primarily influenced by a central authority known as the Federal Reserve, or simply the Fed. The Fed sets the federal funds rate, which is the rate at which banks lend to each other overnight. This rate eventually trickles down into everything: your mortgage, your credit card, your car loan, and yes, even the stock market. Now, why does the Federal Reserve raise or lower interest rates in the first place? It's all about controlling the economy. When inflation is running too high, meaning the prices of goods and services are rising quickly, the Fed might increase interest rates to cool things down. Higher interest rates make borrowing more expensive and saving more attractive, which reduces spending. On the other hand, when the economy is slowing down and people aren't spending or investing as much, the Fed might lower interest rates to encourage borrowing and stimulate growth. Think of interest rates as a thermostat for the economy. When it gets too hot, the Fed turns the heat down. It's too cold, they turn it back up. So how does all this tie into the stock market? When the Fed raises interest rates, it makes borrowing more expensive for companies. That means businesses will spend less on expansion, hiring, or innovation. As their costs go up and profits come down, their stock prices often drop. At the same time, higher interest rates also make bonds and savings accounts more attractive to investors. So many people pull money out of the stock market and move it into safer. This selling pressure can cause stock prices to fall even more. Let's look at a real-life example. In 2022, the Federal Reserve raised interest rates aggressively to combat rising inflation. As a result, the stock market, especially high-growth sectors like technology, saw significant declines. Companies like Apple, Amazon, and Tesla experienced major dips in their stock prices. Why? Because their future growth depends heavily on borrowing and investment. When money becomes more expensive to borrow, those future profits start to look less attractive, and their stock prices drop. On the flip side, lower interest rates usually lead to a bull market when stocks rise. We saw this happen during the COVID-19 pandemic. The Fed slashed interest rates to nearly zero to stimulate the economy. As borrowing became cheaper and stimulus checks rolled out, investors poured money into the stock market, sending prices soaring. Companies with strong growth potential performed particularly well during this time. Now let's think about what this means for you as a beginner investor. First, it's crucial to keep an eye on what the Federal Reserve is doing. Their decisions affect not only the broader market, but also your individual investments. When interest rates are expected to rise, it might be a good time to reevaluate your portfolio, especially if you're heavily invested in high-growth or highly leveraged companies. Conversely, when rates are falling, those same stocks might become more attractive. But here's an important reminder. Do not try to time the market based solely on interest rates. Even though they are a powerful force, they're just one of many factors that move the market. Instead, focus on a balanced and diversified investment strategy. If you're in it for the long term, short-term interest rate hikes or drops shouldn't scare you. They should inform you, not control you. Also, consider your personal financial goals. Are you investing for retirement, for your child's education, or short-term gains? Each of these goals might require a different response to rising or falling interest rates. For example, if you're nearing retirement, you might shift toward more conservative, interest-sensitive assets like bonds. If you're young and have time on your side, short-term market fluctuations caused by rate changes might be less concerning and even offer buying opportunities. In conclusion, interest rates are more than just numbers announced on the news. They shape the entire economic landscape. They influence how companies operate, how consumers spend, and how investors, like you, make decisions. By understanding how interest rates affect the stock market, You're gaining a valuable skill that will serve you for years to come. If you found this video helpful, make sure to hit the like button and subscribe to Mauuak Saving Tips for more beginner-friendly videos on personal finance and investing. Leave a comment below with your questions or your thoughts on what the Fed might do next. I'd love to hear from you. Thanks for watching, and I'll see you in the next video.